After 2 consecutive days of losses, Wall Street was poised for a potential rebound, with investors and traders alike watching the markets closely for any signs of a turnaround. It was Thursday, January 15th, 2026, a date that many market participants had circled on their calendars, anticipating a shift in momentum. In the early hours before the opening bell, pre-market optimism was running high. Futures for the Dow Jones, S&P 500, and especially the tech-heavy Nasdaq all pointed upward, signaling a possible strong start to the trading day. The main catalyst behind this renewed enthusiasm? A blockbuster earnings report from Taiwan Semiconductor Manufacturing Company, TSMC. Their results not only beat expectations, but also reignited excitement for chip stocks, which have been a driving force in the market's recent rallies. This positive news from TSMC managed to overshadow lingering concerns about ongoing geopolitical tensions and recent policy announcements that had previously weighed on investor sentiment. Just a day earlier, the markets had closed in the red, dragged down by declines in both the technology and banking sectors. But with TSMC's impressive results, that negative momentum seemed to be reversing, offering a glimmer of hope for a broader recovery. As the opening bell approached, traders on the floor and investors at home wondered if this wave of optimism would be sustained throughout the day, with chip stocks providing a strong tailwind for the broader market. The market faced a crucial test. Could the positive momentum from strong corporate earnings outweigh the persistent anxieties about tariffs, international negotiations, and the broader economic outlook? Ultimately, the events of January 15th would set the tone for the rest of the week's trading, shaping investor confidence and market direction in the days to come. The semiconductor sector powered the market's rebound, led by TSMC's stellar earnings. TSMC's stock soared 6% pre-market, sparking gains across the chip industry. Micron, Nvidia, and AMD all rallied, reflecting renewed faith in tech's growth, especially in AI and data centers. Just a day earlier, chip stocks had dipped on reports of Chinese restrictions on Nvidia's H200 chips. But TSMC's results reminded investors that strong demand for advanced chips remains a dominant trend. Semiconductors are the backbone of modern technology, making the sector a bellwether for the global economy. January 15th's rally reaffirmed that, despite political noise, chip demand is a powerful, profitable force. TSMC's earnings didn't just boost U.S. markets, they sparked a global rally. European stocks opened higher, with the Stoxx 600 up thanks to surging semiconductor shares. Dutch equipment maker ASML jumped 7%, while ASM International and BE Semiconductor also soared. This ripple effect showed how interconnected the tech supply chain is. TSMC's growth means more business for suppliers worldwide. Investors saw TSMC's results as proof that digital transformation is driving robust demand for foundational tech. For a day, concrete corporate growth outshone macroeconomic fears. The global rally underscored how one company's success can lift an entire sector across borders. Amid the rally, a new White House tariff added complexity. President Trump imposed a 25% tariff on certain imported semiconductors, but crucially exempted chips used to build the U.S. tech supply chain. This carve-out aims to protect domestic industry while encouraging investment in U.S. chip manufacturing. The policy uses tariffs to make foreign chips less competitive, but ensures U.S. fabs can still access needed components. For investors, the exemption was a relief, signaling the administration wants to reshape, not cripple, the tech sector. The market's continued rally showed investors were more focused on strong demand than on targeted trade policy risks. Another major headline has emerged. After weeks of speculation and uncertainty, the Trump administration has officially approved sales of Nvidia's H200 AI chip to China. This decision comes after a tense period where the future of Nvidia's business in China was hanging in the balance, with both tech insiders and global investors watching closely. The approval marks a significant moment in the ongoing tech rivalry between the US and China, and it's set to have ripple effects across the industry. But there's a big catch. The US government will take a 25% cut of all H200 sales to China, a direct revenue share that's rarely seen in tech exports. This means that for every dollar Nvidia earns from these sales, a quarter goes straight to the US Treasury. It's a bold move, designed to ensure the US benefits financially from the deal, even as it allows some technology to flow overseas. President Trump defended the decision by pointing out that the H200 is no longer Nvidia's most advanced chip, so the security risk is considered lower than before. By allowing sales of an older generation chip, the administration aims to strike a balance between protecting national security and supporting American business interests. The move is also seen as a way to keep diplomatic channels open while maintaining a firm stance on sensitive technology. This policy opens the door for Nvidia to re-enter the lucrative Chinese market, which is crucial for its growth. At the same time, the US government secures a financial benefit and keeps a measure of oversight on what technology is being exported. It's a calculated compromise that tries to serve both economic and strategic goals. Still, not everyone is convinced. Critics argue that even older AI chips could help China advance its own technology, raising concerns about long-term strategic risks. The debate highlights the ongoing tension between fostering innovation, protecting national interests, and maintaining global competitiveness. For Nvidia, the decision brings much-needed clarity. Even though the profit margins will be slimmer due to the government's cut, having access to the Chinese market is far better than facing a total ban. The company can now plan ahead, adjust its strategies, and reassure its partners and shareholders. Investors responded positively to the news, relieved to have certainty after weeks of unpredictable headlines. For them, a known cost, even a steep one, is preferable to the chaos of sudden restrictions or shifting policies. The market's upbeat reaction made it clear, when it comes to global tech, having clear and stable rules, even if they come with a price tag, is far better than being left in the dark. This approval sets a new precedent for how the US might handle future tech exports to China. Thursday's optimism followed a tough Wednesday when tech and bank stocks dragged the market down. Tech fell on fears of a renewed US-China chip war, while banks like Wells Fargo and Citigroup disappointed with cautious outlooks. Concerns about shrinking margins and economic growth weighed on financials. The double hit from tech and banks made it hard for the broader market to gain. But TSMC's strong earnings reversed the mood, showing how quickly markets can pivot from anxiety to optimism. The rebound highlighted both the market's vulnerabilities and its resilience. While big tech and banks stole the spotlight, the Russell 2000 index of small-cap stocks quietly hit a record high. It rose 0.7% on Wednesday, its fourth gain in 5 days, signaling confidence in the U.S. domestic economy. Small caps are more tied to U.S. growth than global trade, so their strength suggests optimism about American businesses. The Russell's rally, even as large caps wobbled, hints at a broadening bull market. Investors may be seeking growth beyond mega-cap tech, diversifying into nimble, domestically focused companies. The small-cap surge is a healthy sign, showing underlying economic strength. For investors, it's a reminder to look beyond the headlines and consider opportunities in overlooked corners of the market. Geopolitical tensions, especially between the US and Iran, have kept oil prices volatile. Fears of conflict in the Middle East pushed oil higher, but prices retreated after President Trump signaled no immediate military action. The oil market reacts quickly to political rhetoric, with prices swinging on shifting risk perceptions. This episode showed how war premiums can vanish as quickly as they appear. Oil price swings ripple through the economy, affecting inflation and consumer spending. Meanwhile, U.S. talks with Denmark and Greenland over territorial ambitions added to the diplomatic uncertainty. These events highlight how global politics can inject volatility into markets far beyond commodities. With chip rallies, ongoing tariff debates, and a constant stream of geopolitical drama, investors everywhere are left wondering, does this environment present a real buying opportunity, or is it a time to exercise caution and wait on the sidelines? The market's daily headlines can be overwhelming, making it difficult to separate short-term noise from long-term trends. Portfolio expert Ayako Yoshioka believes there's more to the story. She points to strong fundamentals beneath the surface, robust corporate earnings, healthy balance sheets, and a U.S. economy that continues to show resilience despite global uncertainty. These factors, she says, are often overlooked when fear dominates the news cycle. Yoshioka argues that 2026 will be a year defined by earnings growth, not just headlines. She suggests that market pullbacks, while unsettling, are actually valuable chances for investors to buy high-quality stocks at more attractive prices, setting themselves up for future gains. The recent rally in TSMC stock is a perfect example. Strong business fundamentals can ultimately overpower short-term fears and negative sentiment, rewarding those who stay focused on the bigger picture. For long-term investors, the key is to look past the daily headlines and focus on the underlying health of the businesses they own. It's about understanding what truly drives value over time, rather than reacting to every market swing. Volatility is inevitable in any market, but those dips and corrections can be opportunities, not just moments of crisis. Staying calm and disciplined can make all the difference. The lesson is clear. Stay focused on your long-term goals, use periods of market weakness to strengthen your portfolio, and remember that patience and perspective are your greatest allies in building future growth.